Hello everybody, welcome back to another valuation investing video. And today in this video, I'm going to be going over PayPal stock and why I believe PayPal could be one of the most undervalued stocks in the market right now. So with that being said, in this video, I'm going to start off by going over PayPal's business model and how the stock has actually been performing very badly and why it actually is. Then I'll get into the fundamentals of the business as a whole. Then finally, I'll be taking a look at my intrinsic value calculations to see why I believe we can get a pretty decent return on PayPal stock if we bought the stock today. So with that being said, let's get into PayPal. And taking a look here with PayPal, as we can see, the stock is down 19% year to date, and the stock is performing pretty poorly compared to the S&P 500, which is up 10+% in the past year to date. So with that being said, PayPal stock is really underperforming, and if we took a look at the 5-year chart, we could see it's even worse. The stock was near $400 back in 2021. Since then, the stock has not done anything near what it was doing before. So this stock has been really underperforming over the past 4 or 5 years. So with that being said, let's get into PayPal and how they make money. First, taking a look at the main way they make money is by charging fees on transactions from merchants and consumers, which includes percentages and fixed fee on payments. Also, they get money from cross-border transactions, and they do have some other ways they generate money from added services like payment gateways, credit products, and loans for businesses and individuals. So with that being said, taking a look at the transaction revenues, mainly merchant fees and consumer fees is what builds up their revenue. Also, we have cross-border transactions, which is fees when money is sent or received in different countries. So that's another way they get money, and also instant transfers. Taking a look here, looking at the transaction revenue, this accounts for almost 92% of PayPal's revenue. So this is the main core of PayPal, the transaction revenues, but they do also have some other services such as business loans and credit products. But mainly it is the transaction revenues. And taking a look at the total transactions with PayPal over time, we can see over time it's definitely increasing at a pretty decent rate. However, looking at from COVID 2020 to 2021, we saw a huge jump from then. So that's when the stock was doing insanely good. The stock was up hundreds of percents from 2020 to 2021. However, even though COVID definitely helped the company in that time, I actually think this is a main reason why the stock isn't doing well. We can see the growth is kind of starting to decelerate ever since then, and I think COVID really made PayPal start to get back to normal. So they had a huge surge in transactions due to people being home and people in e-commerce trying to buy online. However, as we return back to normal, we start to see more deceleration in the growth of annual transactions. And as we can see with COVID, we had rapid growth with this company through the global shift to digital payments on e-commerce with the surge in online shopping and digital transactions, and they got record customer growth. So this company was doing really well during COVID. However, since then, we've had some problems. As we can see, PayPal has had a slowdown since then due to increased competition and a cooling e-commerce market. So we're starting to see a return back to normalcy with the amount of online transactions since COVID. And I think that's the main reason the stock has been doing pretty bad. As we start to decelerate growth numbers got worse than what was previously thought back in 2021. So with those growth numbers being worse than previously thought, the stock tanked down a lot, and now we're starting to see slower growth out of PayPal, but also mainly due to increased competition. PayPal faces intense competition from rivals like Apple Pay, Google Pay, Stripe, and Block's Cash App. As we can see here, with the increased competition, we have a bunch of competition with PayPal, a bunch of alternatives too, which is, I think, one of the main reasons why the stock isn't doing good. We have obviously all these companies here: Google Pay, Apple Pay, Venmo, Square, Amazon Pay, Stripe, and a bunch of other ones here. And I think that's the main reason why PayPal is slowing. Also, softer consumer spending. I don't think this is a directly why the stock isn't doing well, but it's definitely another reason. Also, higher interest rates has slowed some spending and cooling e-commerce growth. As we can see, the pandemic boom in e-commerce has cooled, which has naturally slowed the expansion of online payment volume. So with the expansion of COVID, this automatically had us return back to the average, in which with that return back to average, we've seen even worse growth rates with PayPal, resulting in the stock just not doing good. Also, we've also seen a strategic focus from PayPal. Instead of focusing on growth, PayPal has said they're going to start to focus on profitability. So with that being said, their slow growth has concerned the company, but their main focus is now to be more profitable. As we can see, they shifted to efficiency. PayPal is shifting its strategy to focus on profitability rather than just growth, leading to a higher profit forecast for 2025. So they're trying to get higher profits because of the slower growth in transactions and just overall payment volume. So with that being said, they're trying to focus on profit. Also, they're focusing on innovation in core products. The company is revitalizing its branded checkout experience, and they're trying to revitalize Venmo. So this company is trying to innovate and shift to more profitability and increase those margins. So we have to take that into account with our growth numbers for our intrinsic value calculation. So if we go over to my valuation investing website and we type in PayPal, if you guys want to go check out this website, it's valuationinvesting.money. And also, before we get into the fundamentals of PayPal, if you would please hit the subscribe button. Trying to get to 5,000 subscribers by the end of the year, and thank you. So first, let's just take a look at PayPal as a whole. As we see, this Friday the stock was down almost 8% due to the news of tariffs. So this could potentially hurt the stock, but that's not too big of a worry right now. That's more short term, and we want to focus on the long term aspects of PayPal. Take a look here, a market cap of $66.69 billion. And the price to sales is pretty low. The price to book looks also pretty decent. Free cash flow yield, however, isn't great. The free cash flow yield is pretty low compared to the PE ratio, so that's interesting to see. Also, with the net cash, they have negative $2 billion, so they have more debt than their cash. So that's something to keep in mind, but it's definitely not too bad. Taking a look at the fundamentals here, the 7-step stock analysis. These are the 7 key metrics that I like to look at for the stocks I like to analyze. And first, I like to look at the forward PE ratio. This gives us a sense of the future valuation, and right now, this is a very low forward PE ratio of 14. This means you're going to be paying $14 for $1 of future earnings per share from PayPal. Also, with a return on invested capital, this helps us shows the efficiency that this company is at reinvesting back into the business. So they're making about 10.1% with the reinvestments in the business. So that's pretty good. It's not amazing, but it's still a check mark. And both the growth numbers look good, 8% revenue growth, 15% EPS. So taking a look here, if we go to the financial charts, revenue growth looks pretty solid. The net income doesn't look great, but it's not too bad for the EPS. And actually, the net income has been pretty stagnant over the past past 4 years. So this EPS growth number might be slightly wrong because this is the past 3 years. And with that being said, they had a big dip in net income 3 years ago. So this is actually kind of wrong. The EPS is actually might be an X if we take a look at a longer time frame. The shares outstanding, though, is a very good check mark, negative 5% each year. I like to see that they're buying back shares a lot. And with that being said, with the focus to more efficiency, this makes sense. When a company is not focused on growth as much, they're going to start buying back shares to return more back to the investor and to the business as a whole. Since reinvesting back into the business as the core business, it's not going to be as good of an investment as, say, buying back shares. The only X we have here is the debt to free cash flow, so this doesn't look good at 12. So the debt to free cash flow is very bad. I wonder why the free cash flow is so bad. The free cash flow is $6 billion, so in 2024, however, the free cash flow is $6 billion. So that's interesting. Maybe I think their free cash flow has taken a big dip just recently, so that is probably why the debt to free cash flow is that bad. Honestly, I wouldn't be too worried about the debt to free cash flow though, because they have only negative 2 billion in net cash, so they could almost pay off most of their debt with just the cash they have. So it's not that bad, even though it does show a pretty bad number here. So with that being said, let's go to my intrinsic value calculator and get a fair value price for PayPal. First, with the revenue growth numbers for the bear case, let's take a look at what analysts have to say. They expect about 6 to 7% revenue growth. I think bear case PayPal will grow. Let's do 4%. Base case, I'm gonna do 6.5%, and then bullish case. For the bullish case, I think I'll do a 9% revenue growth. So with the bear case, with bear case 4%, I'm assuming this company is definitely going to focus way more on profit margin, and say more competition really hurts the growth of the business. I think 4% is fair. 6.5% I think is fair. If they just continue what they're doing right now, I think that's what's going to happen. And say bull case, we get more spending with PayPal, and say they start to innovate better with their products and more people start to use those products. I think 4% is more likely than the 9%, but the bull case is an aggressive case. Now for the future profit margin, right now their profit margin is at 14%. So for the bear case, I'm going to do 14%. Base case, I'm going to do 17, bullish case 20. I think in turn with the slower growth numbers, they're going to start to get more profitable, and I think 17% is fair for PayPal. And since rates are going to be cut, I think in the future we could see better profit margins with PayPal as more and more people start to spend more. So that's why I think profit margins may increase a bit more from today, especially with their focus on efficiency. Now for the future P ratio, I think right now they're trading at about a 14 P ratio. I think for growing at 4%, they deserve a 13 P ratio. Base case, I'm going to do let's do a 17 PE ratio. 17 PE ratio, and then bullish case, I'll do 21. Say they grow at a 9% rate. Actually, we could do 16. Let's be more conservative here just in case. So let's do 13 and then 16 and then 19. Now for the shares outstanding, I think this company is more focused on buybacks. So I think bear case, they buy back 3%. Base case 4%, and then bullish case 5%. They have huge buyback programs, and I think it's going to continue. Now, with that being said, taking a look at our annual returns here. Base case, again, annual return of 16.3% for PayPal. So if you think that this company can get more efficient, I think that this would be a great time to buy. At a 16% return, bear case, you would still even make 4%, bullish case 29%. Do I think the bullish case will happen? Probably not, but I think base case, this looks like a good investment. Say they even grow 5% and get the profit margin to 15. Let's see what that gives us. And we still get a 12% return with very conservative numbers. So this is why I believe that this company is a very undervalued company. Am I necessarily buying this company right now? Me personally, I'm more towards growth companies. I like to invest in companies that are at least growing at near double digits. This company is growing at mid single digits. So I would have to get a pretty good value on this company. I think if this company got under $60, I might add to a position. So thank you guys for watching this video on PayPal stock and why I believe this could be the most undervalued stock in the market right now. Please subscribe, hit the like button, comment down below. And if you want to go check out my Patreon where you can get access to this entire website, you get a 7-day free trial. Just click right here. There's a button right there. You click on it, it'll go to the Patreon. And thank you guys for watching. See ya.